startup valuations. And this is such an important topic. I get so many questions from our members around, how do we understand valuation? How are valuations set? What are the important things to consider when you are evaluating the valuation of a startup? So we're really going to try and cover a lot of that today, but I want this session to be very interactive. So please feel free to use the chat button. If you want to ask me a more complicated question verbally, feel free to just, I think there's like a raise your hand button that you can press, and that'll allow me to actually activate your mic so that you can verbally ask a question to the group. But otherwise, let's get started. And, as I said, feel free to stop me along the way. So I am just going to change this view a little bit here so that I can see your questions as we go along. See, I think, oh, sorry, give me 1 second to share my screen with you guys, but not in full screen. Okay, so the presentation that I'm going to be sharing with you, obviously you'll be able to see today. I'll, share a recording of today's sessions with you, but if you want access to the actual slides, I'm also very happy to send that along. And I apologize that I don't think I can quite put it completely into full screen, simply because then I won't be able to see any of your questions or interaction as we're going along with the Zoom webinar. Great, so we can get started. So today, as I mentioned, first session in our new series, and I see that I do have one little chat. Let me just make sure. Okay, the slides are great to have. Yes, I'll make sure that you get the slides, Rohan. Really excited to get those to you. So first session in our new investor training series, which will be happening monthly from now on. I think we have it scheduled for the third Wednesday of each month at 1 p.m. So I'd love for you guys to join for as many as you can. And if you can't make it, also happy to send your recording. But of course, it's a lot more fun when we can see all of our participants live. So Startup Valuations Explained, right? Let me just give you guys a little bit of my background. For those of you just joining in, my name is Erica Diagnan-Minahan. I am the founder of 1,000 Angels and co-founder of an early stage fund called Rain Ventures. I've actually spent the last 13 years investing in seed and Series A stage companies. I started off as I actually started my career doing investment banking, did that for 8 years, and decided that I was ready for a change from public market securities, and actually got into early stage venture because it's such a wonderful asset class in that, when you buy stock in a company, as an owner of shares, you're very far away from the company, but as the owner of equity in an early stage company, you can actually be really close to the founder, to what the company is doing, to the mission, to seeing it grow, seeing it create new product and change the world. And that's what I really love about early stage investing, and I hope to be able to share that with all of you. So I started off my VC career as executive director of Golden Seeds, which is now one of the largest angel investor networks in the world. It's an in-person angel network, though, which is a critical differentiator between Golden Seeds and something like 1,000 Angels, which has members globally, because we are a completely digital platform with occasional in-person events. Also served as managing director at Dream It Ventures, which is an early stage fund for over 3 cycles. So during that period, was able to work very closely with 48 really amazing companies that came through our program during that time. And as a member of the GP for that fund too, actually have a portfolio of 180 early stage companies that came through Dream It over the last few years. So during that time, over the last 13 years, I've invested in well over 100 early stage companies, and worked with probably close to that figure as well, very closely. So I have a lot of experience in this particular sector and really love what I do. School-wise, I got my MBA in finance from Columbia Business School, as well as an undergraduate degree in business economics from UCLA. So you will see that talking about something very nerdy like valuations is going to be one of my favorite topics. My expertise, especially in the startup area, is very much around capital strategy. So helping companies understand how much they need to raise and when, and understanding a great strategy for growing valuation as your company grows. So I think that one of the big reasons that I've had some requests for this topic from 1000 Angels members is because it feels like things have gotten a little bit out of control in the funding world, right? So quote unquote, startups valuations are skyrocketing. You know, you heard about the $47 billion valuation scheme that SoftBank tried to pull off. You know, you hear about, you know, what questions around what metrics people are actually using in order to establish these valuations. So it's completely understandable that there's been a little bit of cause for concern over the last 2 years. And I think that as somebody coming in on the very early stage, you know, it's helpful to understand, okay, you know, what's going on? How are people coming up with these numbers? And, you know, why have these issues even come into the market? So, you know, one of the things that we probably want to address right off the bat, you know, just to sort of address the elephant in the room, which is the WeWork debacle, right? So, you know, WeWork, I think during before the big crisis had probably raised, I think somewhere around $18 billion and kept raising sort of a few $billion every year at doubling valuations. So, you know, it would go from a $15 million pre-money to a 30 to, you know, a 60. So it just kept kind of like every time they had a new funding round, SoftBank would very arbitrarily double the valuation. And I think that, you know, as one of the reasons they say that it was a fiction created by SoftBank is that SoftBank was kind of, I think, trying to establish a certain momentum of valuation increase, and so that they could justify taking the company public at $100 billion valuation. So we all know that that didn't happen, didn't even come close to happening, because people got smart towards the end and questioned the valuation, and appropriately the institutional investors that would have taken the round decided to pull out. So disaster averted, because it could have been a lot worse if they had actually been able to go through with that IPO versus SoftBank actually taking a bit of responsibility for the situation that it had created by overvaluing the company. So we can see that's a really great example of why overvaluation of a startup can actually lead to disaster. And there are, of course, you know, that's probably been one of the biggest dangers in the last, I want to say, 5 to 6 years or so, is startups raising at too high of valuations. You know, even many years ago, you saw some companies like Gilt Group. I think they did their last round, you know, at somewhere around $800 million to $1 billion pre-money valuation, and then the company ended up being sold for, I think, $225,000. So there have been many instances of companies at the late stage getting large private equity investment and being overvalued, and how that can create disaster for investors down the road. So we want to be careful about companies being valued too dearly, right? Overvalued. And then we also want to be really careful about the companies that we invest in also raising capital too cheaply. And so, you know, one of the big reasons that this can be a big concern is that if the companies raise enough money at the early stage on too low of a valuation, what will happen is that the founders will be completely diluted off of the cap table, and there won't be room for new investors as the company grows and needs to take on additional capital. So, you know, you might think, oh, look, this company's raising, you know, $1 million at a $2 million valuation. That's a better deal for me, right? It's cheaper than the company that's raising at a $4 million valuation. And in theory, it seems that way. But in the long term, it's probably not healthy for the growth of the company, considering that they'll likely need to raise more capital in future rounds. And, you know, with the scenario that we just outlined, you know, they've already diluted themselves by about a third. So these are some of the considerations that we want to be really aware of as we're thinking about the health of the cap table of the companies that we're investing in, how much dilution is taking place at each round, and how that's affected by the valuation of the company. So too high can be bad, but also too low can be bad. How do we sort of get this happy medium? And as investors, it's our responsibility to make sure that we have sensible expectations about startup valuations, but that we still remain competitive, right? So things, are very cyclical in the markets. There's no hard and fast rule. When people are more excited about startup investing and there's more capital flowing in at the early stage and folks feel optimistic, the market can get a little bit frothy. That doesn't mean that, you shouldn't invest, right? Because this isn't sort of a market timing sort of asset class. There was a great quote from Eric Schmidt to Sheryl Sandberg that says, when somebody offers you a seat on a rocket ship, you don't ask which seat, you just get on. And so for us, there's very much coming in at the early stage, there's very much this, just get on the rocket ship mentality. But at the same time, we need to be really prudent about sensible valuations that make sense both from an investor perspective and a founder perspective that are also competitive to what the rest of the market's doing. So by understanding the basics of, being able to estimate a company's valuation and, understanding also what's going on in the market, you can make better, smarter investment decisions. So you're not going to, accidentally invest in a company that is, sort of overvalued in its terms, or you're not going to accidentally invest in one that is at a problematically low valuation. So really doing this analysis is our job at 1,000 Angels. And, we think through this very clearly on every single deal that we look at to make sure that our members are in the right place. So we're going to get into some detail around, sorry, the lights are on some sort of a motion timer. I guess I'm not moving enough. Hang on a second. Okay, there we go. I'm actually at PayPal headquarters, not at my office today. So hopefully the light won't go off too much during the presentation. So today we're going to be sort of talking about what is in the secret sauce, right? What are our basic guidelines that will allow you to understand how we select deals and how we would determine if they're appropriately valued. So what we are currently doing for our members at 1,000 Angels is we are just constantly out there participating in the early stage capital markets, which means, meeting with founders, getting to know them, mentoring them, giving them advice, listening to their pitches. And we're constantly keeping our eye out to find where we see the best risk-adjusted return. I don't know what is going on with this light today. Hopefully you guys will be able to see me. Sorry about that. Where we can see the best risk-adjusted return in the markets. So, what companies do we feel like are kind of at that inflection point where this is the right time to invest now? They've sort of created enough value that it's worth actually, like we feel there's major potential for appreciation in the equity and it's the right time to come in. So we're going to be talking about how we are able to find deals that are the right balance between financially attractive and, overpriced, right? So we don't want to be in things that are too cheap, and we certainly don't want to be in things that are overhyped. As you know, a lot of stuff that comes out of, okay, I'm just going to have to do this in the dark. A lot of stuff that comes out of Silicon Valley tends to be overpriced. I apologize. I'm going to see if I can just turn this on. It's a little hard to. Okay. All right. I'll pray for the best. It's not so, I don't like you guys having to look at me in the dark, but that might end up being the situation. So how do we walk that fine line and make sure that we're not in things that are overhyped and overpriced? So you don't want to be in the ones that are too expensive, but you also don't necessarily want to be in the ones that are cheap, because they're usually cheap because they're missing something important, right? And that could be the proper team, the right amount of traction, or most importantly, that they don't have product market fit. So we're going to get a little bit into the details and go over the basics of valuation guidelines. So this chart here shows you guys some general valuation guidelines that you can take a look at. And I think that this is, probably one of the most important things to kind of keep at hand as you're trying to understand, where a company is and how we establish valuation. So typically there are a few different rounds of funding that an early stage company will participate in, and you'll hear these terms thrown around a lot. They're quite arbitrary, and people tend to move them around a little bit for what we call optics, right? So to make your company look better, back in the day, maybe a decade ago, what was considered a Series A is now called a seed, right? What was considered a seed round is now called a pre-seed. So terminology is always changing, but what isn't changing is sort of the basic ratio of the approximate size of the round to the valuation of the company. So for the vast majority of startups, you're going to see them doing some sort of pre-seed round, and a pre-seed round would typically be the first $250 to $1 million that come in. And assuming that this initial investment of capital is not coming from the personal capital of the founders themselves, typically the valuation range for investments at that stage would be anywhere from kind of 1 to 5 million. Probably not quite as low as 1, but it's possible that if somebody was taking in just a few $100,000 from friends and family, they might give them a bit more. But generally, it's basically sub $5 million. And I would say even more, kind of closer to $3 to $5 million range. But I've invested in deals as a non-friend and family where the valuations have been as low as $2.5 million. So what are the sources of capital for these rounds? Well, these are primarily friends and family rounds. And in the case where valuations get very low, it's very possible that the investment, particularly if it's from friends and family, might be in common stock, which is valued more attractively than the later stage investment securities, which would be preferred or participating preferred. But that initial investment, which very often can be common, would come from friends and family or accelerators, right? So typically friends and family putting money in, accelerators putting money in, they are getting common stock, so the valuations can be quite low. I think that when I was at DreamIt, they've since sort of changed the methodology, but we got something like 6% of the common stock of a company for only $25,000. I think now it's up to closer to 6% for $125,000. But point is that investments in common stock in the very early stages can actually be done at quite low valuations, and usually these companies are pre-revenue. So that's what we would consider a pre-seed round. And it's the type of thing, that you probably should not be investing in unless this is a person that you either have a family relationship with or that you know extremely well. Sorry, it's just driving me crazy being in the dark for so long. So that's a little bit about pre-seed, and you'll see valuations there being 5 million and lower. At the seed round, which is usually a raise of about 1 to 3 million, you'll now see valuations move up to about $4 to $12 million. And participants there are angel investors, micro VCs, seed VCs, and what are called scout funds. So those are kind of like maybe associated with a larger fund like a Sequoia or Excel. They'll send a few folks out there to kind of scout potential investment opportunities that have the ability to issue small checks. So this is definitely a stage at which it's certainly more challenging for for founders to find lead investors for their deals. And at this point, the company usually has somewhere between $20,000 and $100,000 in monthly recurring revenue. So they've definitely achieved some really strong traction, and they have good revenue, but it's not yet clear if the company is actually scalable. So that's why, it's still a bit of a riskier stage. Even though there's some proof of concept, and why there's such a great opportunity for, from a return perspective, for investors who are willing to participate there. And you'll see that reflected in the valuations of between $4 and $12 million pre-money. But a key thing to sort of look at as we're looking, at the round size versus valuation as we go down the line is that usually in any particular round, the valuation is very much a function of both the traction of the business as well as the round size, right? So you are typically only able to raise a certain amount of capital based on, the amount of traction or revenue that your business actually has. And then your valuation will usually be a function of that. So your valuation will usually reflect that the new money in will be somewhere between usually 20 and 30% of the total company. So for example, if you are raising, $2 million for your company at a $6 million pre-money valuation, that means your new investors get 25% of the company, and that's kind of an appropriate amount of capital to raise for the valuation. The 25% falls, right exactly in between our 20 to 30% window. And so that would be sort of a prudent size of round and valuation for a company to raise. Getting on to Series A, these days, what you'll hear from, most, real VC firms that are investing in Series A is that the minimum amount of revenue needed is $100,000 in monthly recurring revenue. So it's basically a business that's doing about $1 million a year. The reason that we sort of express it as monthly recurring revenue, especially at this stage, is because, if the business is growing, 10, 12, 15% month over month, they might not have had an entire, million in revenue over the course of the year, but if it's recurring revenue based on sort of what they're earning that month, you multiply it by 12, assuming it's some sort of a subscription business, which a lot of businesses are these days, and you get to 100K in monthly recurring revenue, implied annual revenue of 1.2 million and growing. So at that stage, you're now interesting to traditional early stage venture capital funds who like to invest in Series A rounds of 3 to 10 million. And valuations there usually end up in the $12 to $30 million range, depending on what type of business it is and what assets of value you have in your business. Series B typically is happening around $10 to $25 million round sizes, valuations of $30 to $100 million, and 3 million or more in annual recurring revenue. And of course, later stage where you get to sort of growth equity rounds of Series C and beyond will be rounds of usually 25 million or more with valuations of 75 million or more. And the investors there are growth stage VCs as well as private equity funds. So that's just a little bit about sort of the stage and players and where capital comes from. But it's a really good guideline to help you kind of understand what is the capital path of a startup. So if you are participating, in a startup seed round, right, they're raising $3 million, let's say they're doing, 75,000 in monthly recurring revenue, and you're paying a $12 million valuation for the equity, you have to realize as an investor, well, I know that the next inflection point, for them to do another round is, getting a Series A done. Will they be able to meet, the metrics of the VCs and seem investable at that point? And if they need to raise more capital, like, do I see them sort of getting to these next milestones? So we'll be talking a little bit about valuation milestones. And for companies that, aren't necessarily getting to break even very quickly, or if you are trying to evaluate their potential exit opportunities or potential for additional liquidity, we'll see, what are the milestones that they need to meet to continue to raise funding. Okay, great. So on to the next slide. All right, great. So this is a really fun little diagram that shows you a little bit about valuations versus traction, right? So sort of another way to break down what we saw on the previous slide. And what this chart shows is that, kind of at the general early stage, right? Everyone's a little bit different, but at the general early stage, you're going to see companies being valued 3 million probably at the lowest, right, for external capital, to say maybe $15 million for an early stage company. And so what is sort of the path to actually creating that value? So, a company is starting off with just an idea, then they maybe have some sort of like a mock-up, then they put together a minimum viable product, right, which is sort of the most basic version of the product that they can do to test on customers. If people like that, they might get some pilot customers. These could be, unpaid customers who are just sort of trying out the product and giving you some feedback who you hope might eventually convert into paying customers. And then the next step is revenue. Once you start generating revenue, if people who are paying for your product really love it, you can establish that you have product market fit. And then from that, once you know you have product market fit, you can invest in growth. So these are kind of the 7 stages, getting from idea to, potential growth stage of a startup, and the different milestones that the companies need to meet. And as you see, the valuation kind of, increases linearly as you make those gains in value for your company. And so what we're sort of showing here are some of the factors that can cause a company valuation to be on the higher side, right? So to make it a little bit more expensive doesn't mean that it's not worth it, or a little bit on the lower side. And it could be cheap for a variety of reasons, and we'll talk about some of the reasons. So one of the first reasons that you're going to see companies that are, not that far past idea stage, that are maybe even before MVP, being valued, more expensively than you would normally expect, is that they're from Silicon Valley. Sorry, Jasmine, I know you're in San Francisco, but everything is expensive there, even the startups, or they've been in Y Combinator, right? So having either of those things usually makes a deal a little bit more expensive, for a variety of reasons. The main one being that there is so much capital in the Bay Area that can be chasing too few deals. It therefore raises the price of everything the same way that it does with real estate. It also raises the price of startups. The great thing is that if you live in the Bay Area, you're forced to either buy or rent an apartment there, but you can always make your investments in cheaper companies that are in other locations. And so that's why we see on the other side of the line, in sort of the under the line where things are a little bit cheaper, is, companies that are not from the Bay Area, not from LA, not from New York. So, if you have a company in Cincinnati, or even like Denver, or even Miami, or wherever, the round ends up usually being done at a more attractive price, for the exact same reasons, which is that the founders there just don't have as much capital chasing deals, as much access to capital, so prices are better, even though those companies have just as much opportunity for growth as ones that you see in more expensive cities. Another one that can really drive up prices by a lot, but probably for good reason, is if you're investing in a company that has previously successful founders. So, if the founder of this company previously, started a company that's now valued at $1 billion, and he's, doing a seed round, it's very likely that it's going to happen at, a $10 million or higher pre-money valuation, even if they haven't done anything yet, right? So you're sort of paying for successful founders who are exceptional, who are either, previously exited or, celebrities in some way, who are bringing additional value to the table. So that will also drive up the valuation. In the same way that, if you have a company that has female or minority founders, you're going to find exceptional value investing there. Because in the same way that, a exited founder gets sort of a valuation bump and more demand, the unfortunate truth is that female and minority founders, tend to have less success in raising and less demand, particularly at the early stages before they've really had a lot of chance to prove out the concept. So you can see, that they would probably need to get all the way to product market fit to, get a similar valuation to, a YC minted startup, right? So they kind of need to, prove a lot more to get to the same valuation. But for that reason, a lot of smart folks are really excited about investing more in women-led and minority-led startups because there is value there, right? So every time you're kind of investing in something that's a little bit sort of under that yellow line, that area is where we can generate alpha from a risk-adjusted return perspective. And then, the last above the line factor that I want to touch on is if you have valuable intellectual property, right? So if you have some sort of amazing software, that is patented, that is doing something fantastic, that, is very proprietary to you or is patented in some way, you have that competitive advantage to that intellectual property, that alone is going to boost your valuation even at MVP stage because you now actually have a real asset in the business. And to counter that, on the other side, you're going to find lower valuations for companies that produce consumer products, not because it's not possible to make a great investment in consumer product company, but because they are a little bit less scalable and they generally don't have the same sort of intellectual property protections that digital and technology products have. As well as they are encumbered a bit by the idea that, you actually have to make things, have inventory, sell them. So those are just a few of the things that can push a valuation higher or push it a little bit lower. But in either case, there are benefits generated by the reasons valuations are pushed higher, and sometimes challenges generated by the reasons that valuations are pushed lower. And so what we need to do is we need to, think to ourselves, does the current valuation make sense? And am I able to see some value in areas that other people might think detract from value, or am I able to recognize the value of something that's making a deal a little bit more expensive? So hopefully this chart is helpful to you guys. So I just want to stop for any questions. I don't think I've had anybody ask anything so far. So it says no open questions. All right, great. So I'm just going to continue on. And once again, I apologize. I don't know why their light just keeps going off on me. PayPal's trying to save money, so I apologize. Okay, great. So on to our next slide. Great. So the next one is also kind of handy for you guys to hang on to. And this just kind of shows you what, basic valuation milestones should be at various rounds. And this is really critical. If you're investing with 1,000 angels, you don't have to worry so much about, making sure you check off these boxes, because we really do that for our clients. But just for you to understand, what the boxes are and, why we, why founders here know so much, right? Because there's so many things that you actually need to get to before, you're really entitled to raise money. It's not like, oh, everybody can raise money, right? You have to really meet, certain very difficult milestones in order to raise capital. So we start, at $0 in revenue. That's really where people are raising money from friends and family. And I would say even at zero, it's going to be pretty hard to get your friends and family to invest, all the way to sort of, $1,000 in monthly recurring revenue, right? So you start at zero, you need to build the team, you need to build a product, you need to do research on your customers, and you need to hopefully test a minimum viable product with potential users. By the time you get to even $1,000 in monthly recurring revenue, hey, you've done something, right? Because you sold, at least one of your item or whatever it might be. So you have actually achieved some level of customer validation, some level of minimum viable product validation. And now your task is to basically improve upon the product so that you can get to the next level, which is probably around $10,000 in monthly recurring revenue. So at $10,000 in monthly recurring revenue, this is like a very unattractive lifestyle business, and you are maybe outside of the friends and family zone at this point, but you're still securely in the pre-seed zone, which could include being in an accelerator, raising from high net worth individuals that you have a relationship with, and then taking in a little bit more money also, maybe from friends and family. But at this point, you're going to be really focusing on building your customer acquisition channels, establishing your proof of concept, and finding, that holy grail product market fit, right? So that's really what you need to figure out. And product market fit just means that your customers really, really like your product, and they would be very disappointed if they were not able to use it. So finding that is a lot more challenging than it seems. And so you see a lot of companies having a hard time kind of breaking to that next level. Now, once you've, reached close to 100,000 in MRR, sort of during that range, you're going to be able to raise a seed round. Once you get to 100K in monthly recurring revenue, you'll have product market fit by this point probably. And your next challenge is to find scalable customer acquisition channels. And these are what we call sort of deep pools, right? So, it doesn't help me if I'm doing $100,000 in monthly recurring revenue, and I was able to do that, by finding 100 customers that I had to kind of, or I had onboarded, 100 customers from the bowling league or my church, right? Or, someplace where I actually had a very close relationship and was able to sort of make all of those sales one-on-one, because it's not easy for me to say, replicate me, being in a certain church or a certain bowling league or, my sorority or whatever it was that sort of gave you the ability to build to that level of, those 100 customers. You now have to figure out, okay, what's a customer acquisition channel that is scalable and repeatable, right? And this is what we call a deep pool. So if you're able to acquire new customers, for $100 each, but, the way you've been doing that, you're able to convert, 5% of your customers, but the channel that you're using only has, 1,000 people total that you can reach, and you can only convert 5% of them. That's not very attractive than if, you're able to convert at a 5% rate, but there is a pool through, say, digital media or whatever sales channel you have, where there are 1 million potential customers. So we need to be sure that, number one, we've found a good customer acquisition channel, but that it's also scalable because there's a deep pool there. So once you kind of are able to crack that nut, and you're sort of at Series A stage, you're getting closer to 250K in monthly recurring revenue, you're ready to scale because you've figured out a repeatable sales strategy. And that is really kind of the key to doing the larger Series A, is that you have to establish product market fit, and then you also have to establish a repeatable sales strategy. So those are really like the main drivers of value to, get a company from, as you can see on the bottom, we're going from kind of like a $10 million valuation to a $15 million valuation. So, you know, creating these sort of inflection points in value requires achieving, you know, these different milestones. And then, of course, by the time a company is getting to closer to $1 million in monthly recurring revenue and they can do a Series B, they've achieved product market fit, they've achieved sales fit, they've achieved customer acquisition fit, and now the additional funds are just going in to drive growth. And so that's why these are called growth stage VCs, is because like you spend the entire previous time, which is, you know, can be 5 to 7 years, just figuring this all out, right? So it takes a lot of time, and it's really challenging for companies to figure it out. But by the time they've figured it out, now it's just about, you know, dumping capital in the top and repeating these sales strategies or customer acquisition strategies. So that's why at this point it becomes much easier for them to raise much larger amounts of capital and to get valuations of 30 million and up. And what you can see here, you know, what we're sort of demonstrating, and what, you know, you should be aware of as a founder, and what as an investor, and what the founders need to be aware of, is that by the time that, you know, professional investors, like basically non-friends and family people, are coming in, right? As you can see at that pre-seed round, which is probably the earliest, you know, you would ask a stranger to put in money, and there's a $5 million valuation. At every next inflection point, there's sort of an expectation that the valuation is going to double, right? And so that's what we talked about like that WeWork thing that they were trying to pull off. But this is very true, you know, at the early stage, which is that, you know, what we're sort of looking for is that as a company goes from pre-seed to, you know, true seed to a Series A to a Series B, you're going to, you know, get approximately, you know, a 50% to 100% increase in valuation. And, you know, that's what makes investors happiest. So if somebody comes in, you know, at the $5 million round, and the next round is done at 10, and the next round is done at 15, you know, you've got the sort of momentum that is going to keep investors happy. And as an investor, you know, this is kind of the type of momentum that you're looking for as the companies in your portfolio grow and continue to raise follow-on rounds. It's particularly important that they're able to maintain this valuation acceleration momentum, because as the valuation rises for the following rounds, you are less likely to suffer dilution as an investor to your original stake. So if you do not do what's calling exercise your pro rata, right, which is to put additional money into the company to maintain your original ownership, you will be diluted a bit. If the subsequent funding happens at a valuation that is, you know, at or below the valuation you invested in, you can be diluted significantly. If it happens at a much higher valuation, the impact of dilution is less. So, you know, we want to see a nice, you know, sort of steady, reasonable increase in valuations. But you know, as long as they're happening at reasonable rates, it's actually good for us, because maybe we now have an opportunity to put some more money in and either increase our stake or maintain our equity stake. So any questions there? Okay, great. I have one for Rohan. Rohan asks, I can understand how the past success of a founder can raise value. As for IP, are there any markers, number of patents? No, so it wouldn't be number of patents. I mean, it's really just, it can really be any sort of intellectual property. It doesn't even have to be a patent. You know, it can just be, you know, that they've built some amazing technology that's even very difficult to replicate, right? So as long as there is some intellectual property there, it is going to add some level of value, because, you know, many companies really just don't have any intellectual property at all. So we don't really necessarily do it by number of patents. What we do, you know, the way that you're evaluating it is really just by like the value of that particular intellectual property. It could be a patent, it could be technology, it could be some barrier to entry, it could be be, you know, a unique relationship that they have, or an exclusive agreement, you know, that they've signed with somebody. So there are a lot of different things that it could be. And, you know, as we said, valuation is a little arbitrary depending on how valuable that strategic advantage is through the intellectual property will dictate just how much more expensive the deal will be. So I hope that answered your question. Okay, great. So let's talk a little bit about the specific factors that drive startup valuation. And I know I said I was going to stop talking at 1:40, but I will keep going until 2. And if folks just kind of want to like interject a little bit along the way, I feel like I'm not going to get through all of these slides during the time we have allotted, but if you want to interject along the way, I'm happy to answer questions kind of as we go. But let's just briefly sort of talk about the specific factors that drive valuation. And in fact, I might have to just make December's session Startup Valuations Part 2, because the end half of this presentation involves a ton of math stuff. So we're probably going to need its own session to kind of go through it more closely. So what drives value in an investment? Number one, strong management team, right? That is number one. You know, 2 is size of the addressable market. Total addressable market is crucial. Product market fit, we talked about that. Customer acquisition channels and scalability. To Rohan's question, competitive advantage, you know, often through intellectual property. Barriers to entry, first mover advantage can be considered valuable sometimes. Existing traction and growth potential, right? So we've seen, you know, markets like cannabis and video and, you know, other markets that are growing, you know, the companies that go into those space get, you know, healthier valuations than companies that are not in growing markets. So growth potential of the market can also really impact a company's valuation. And then of course, really it's based on exit opportunities. So if you're building something and it's really clear why, you know, Google and Apple are going to need to fight over your company to acquire it, you know, that's also going to drive valuation. So if there's like a very clear strategy for, hey, there are a few different really well capitalized acquirers out there that we know are going to want to buy this asset in the next, you know, 5 years, that can also really drive the value of an investment. So if we talk about how management team drives value, you know, experienced or serial founders, you know, definitely it's much more valuable to have a company with several talented co-founders versus a solo founder. And you'll often hear that it's, you know, nearly impossible to raise money as a solo founder. So, you know, having a team in place, a CEO, a COO, and a CTO, if it's a technology company, are considered kind of the trifecta of what you must have. And, you know, if it's not a company, not a technology company, but it's a consumer products company, then you need to have probably a CMO. So usually kind of a 3-pronged team is, you know, what you at least want to see with any combination of those 4 roles that you feel is most valuable to that particular type of company. You know, another thing is that they have to have relevant expertise. They can't just show up and say, oh, I'm the CEO, I'm the COO, and I'm the CTO. Like, they need to actually have backgrounds, you know, that are relevant to the business. And, you know, it's very interesting because I see a lot of folks, you know, who are kind of like coming out of college and they think, oh, you know, I should be able to start a company. They have no experience, you know, they have no relevant expertise or particular reason. You know, just because you have an idea doesn't mean you're the person to execute it. And, you know, as you guys know, I mean, I have no problem investing in, you know, companies, kids that are still in college. You know, one of our best performing investments is in a company called MadeBot, and the founder was 19 years old when we made our first investment in his company at a pre-money valuation of $5 million, and the post-money on his last round is $40 million. So, and that's, I think, in a space of 2.5 years. So no problem if you're young, but we need to know, you know, why you, right? And he had a really good explanation as to why he should be the CEO of this company. So you need to make sure we understand what is it about this team where they're bringing unique and tangible value to the table, and how do we value it as such. And of course, you're valuing their sweat equity. So, you know, what they as a team have been able to build so far. So as we talk about addressable market, you know, for something to be investable, you pretty much need a total addressable market of 1 billion or more, because this can dictate really how large the company can grow, right? So anytime we're investing in a startup, we kind of need to make sure, all right, does this company have the possibility to grow to 100 million or more in annual revenue? You know, do I think that's possible? If you don't think it's possible, it might not be the best investment, because number one, for companies to be acquired, right, or to go public, they need to get to a certain scale in revenue, right? So for example, for an acquirer, they want to acquire a company that is going to do what we call move the needle, right? So if the company only has, you know, $10 million in annual revenue, that's not so interesting to, you know, a Procter & Gamble or a Nabisco or, you know, Kraft or whoever is the potential acquirer, because, you know, these companies are doing these transactions so that they will be accretive to earnings and accretive to growth. They want to make sure that when they go through the hassle of making an acquisition, that it's actually going to have an impact on their overall bottom line, which is probably already huge. So there's that. So when they make the acquisition, the company needs to be of sufficient scale, but then there also needs to be room for growth after that exit. So if the exit is happening to another corporation, the corporation is buying the company because they feel like they can acquire it, and through their unique distribution channels or different cost structure or whatever, they can create tremendous growth. Or if a private equity firm purchases a company and puts it into a roll-up, they are doing it because they think that there's growth potential. So your addressable market needs to be, you know, of the company needs to be large enough so that not only can the investment be made and grow to size, but then there's additional upside for the acquirer after exit. So, you know, as we talked about before, a growing total addressable market is preferred. That's why we've been looking at some of these interesting sectors as of late that have a lot of growth. So next step that's really critical is in driving value is what we call product market fit. So we want to understand why it's so important and why it's so misunderstood. So really, the holy grail for any startup is finding product market fit. So if you've ever done one of these surveys, you now know the reason why is that startups, you know, or companies use them to determine whether or not they've actually achieved product market fit. And you can see here that Slack, you know, showing their answers to the survey, they feel that they have definitely achieved product market fit. And they had 51% of users who would be very disappointed if they could no longer use Slack, and 39% somewhat disappointed. So, you know, the fact that 90% of users would be disappointed if they could no longer use Slack, I think I might actually be in the 10%, because I find I'm like, I don't need another communication channel. But basically, this is what you need in order to actually achieve product market fit. I think, you know, you want to get this number to at least 70%. A really great technology like Slack is all the way at 90. But it's quite a difficult bar, and, you know, this is where a company needs to be in order to, you know, actually create value. And the reason that it's so crucial to creating value and why it really makes the difference in evaluation is because it's actual tangible validation that the customers not only want the product, but they value the product, right? So valuing the product establishes a possibility for monetization. If somebody just likes something but doesn't necessarily feel any pain if they can no longer use the product, it's going to be really hard to monetize, right? If it's kind of like, hey, yeah, that was fun and I used it when it was free, but, you know, as long as it's going to cost me something, you know, I'm not paying because I only pay in order to avoid pain. And if there's no pain for me not using your product anymore, I don't really want to pay for it. So that's basically the easiest, fastest way to understand whether or not there is a possibility for monetization. And the reason why it's so dangerous to invest in a company that does not have product market fit is because if it does not, and the company raises money to grow marketing efforts, right, or sales efforts, what happens is they're going to pay to acquire customers, and those customers are going to just churn out. So it's essentially setting fire to investment dollars, and, you know, really sort of dangerous growth because it's economically destructive. So a little bit on that. The next sort of big contribution to valuation is understanding the value of the company's customer acquisition channels. So the rule of thumb is pretty simple. It's that the customer acquisition cost should be less than 3 times the customer lifetime value. So if a customer is going to, is expected to spend $300 over the course of the lifetime, if it costs $100 or less to acquire that customer, that's generally considered a pretty attractive ratio, right? So you're making money. The way that the ratio of CAC, or customer acquisition cost, to LTV, right, customer lifetime value, affects value is that it's essentially giving you a formula for their system for making money. So if for company A, it costs $10 to acquire a customer who's going to spend $100 with the company, right? And at company B, it costs them, for whatever reason, $50 to acquire the customer who will spend the same $100. Usually company A is considered far more valuable than company B. So this is how we use this metric to establish relative value, and why having a good CAC to LTV ratio can really drive the valuation of a startup. So some considerations beyond just the ratio. Number one, what is the payback period, right? If it takes 12 months to recover the money that was invested in the acquisition cost, that is not good, right? So ideally, we love to hear that the customer acquisition cost is actually recovered on the first sale, right? So that's sort of your best case scenario. Sometimes it might take a few months of membership or subscription to recover your customer acquisition cost, but the sooner that money comes back, the better. That's the first thing that you're looking at. The next is, of course, the impact of product margins or cost of goods sold. So, customer LTV is just the actual price that's paid. It doesn't necessarily include product margins. So if the product doesn't have a very healthy gross margin, you could have a good CAC to customer LTV, and it's still not necessarily a great value investment. So, a couple of things to think about is that shorter payback period definitely leads to sort of higher value on the company. An extremely long assumed customer life, if they're like, yeah, we expect our customer to be on for the next 5 years, I wouldn't buy it. That implies, much greater risk and lower overall value. So I really apologize, you guys. This whole session ended up taking a little bit longer than I had hoped, but it was so much fun to talk to everybody today. Please feel free to email me directly if you have any specific questions. I'm going to send everybody the recording, and I believe that what we will do is continue on with valuation methodologies, which is kind of how we do the actual calculations, just diving into the math. I might actually just set up an interim follow-up session maybe in 2 weeks. So maybe like the week after Thanksgiving, so that we can finish up today's presentation, and I would love to see you guys all there. So thank you so much for joining, and please be sure to visit 1000angels.com to learn more about us and what we do, and email me, Erica@1000angels.com, if you're interested in learning more about the open investments that we have, because we have some really good ones, and hopefully I'll see you guys all in a couple weeks. Thank you.